Okay, so you look at a stock chart, right? And it just goes vertical, like 300% in a few weeks. The immediate question is always, is there something real driving this? Or is it just, market hype gone wild? Today, we're looking at a company that's been doing exactly that. Mercurity Fintech Holding, ticker MFH. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Our mission today is a deep dive into MFH. We're pulling together everything from our research captured this morning, October 6th, 2025.
Right. And setting the stage is important. Pre-market futures are looking green this morning. The Nasdaq's giving things a nice tailwind, which, helps a stock like this. But there are a couple of big asterisks today. First, analysts generally see pretty subdued growth for the whole IT services sector. And second, we've got a Fed official speaking later. That always adds, a layer of unpredictability.
Okay, so the broader market is kind of positive, but maybe a bit jumpy.
Exactly. Walking on eggshells is a good way to put it. Interesting, because that caution seems totally missing from MFH's own story. I mean, if you wanted a checklist of buzzwords, they've got it. AI-powered infrastructure, blockchain, digital assets. Their chief strategy officer even put out this big article recently about managing digital asset treasuries. It paints this picture of a company that's perfectly built for the future.
Yeah, the vision is definitely forward-thinking. But here's where it gets really interesting, based on our research. There's this massive gap, almost like a void, between that vision and the actual financial reality right now. Put simply, we can't build a standard fair value model, based on cash flow, earnings.
Yeah.
That fundamental data is just not there.
Not there at all. So how are people valuing this thing?
Well, that's the thing. The valuation is astronomical. We're looking at a price-to-book ratio that's about, get this, 62 times the industry average.
62 times?
Yeah.
Seriously?
What's normal?
Normal. The S&P 500 average PB is under 5 right now.
Yeah.
So, 62 times isn't valuation. It's pure speculation. And another thing, there are 0 major analyst recommendations. Wall Street hasn't touched it. Wow. So this is really a retail narrative play, isn't it? Less finance, more psychology.
You could say that. And the crowd psychology. Pure euphoria, judging by the options market.
Oh, yeah. What are the options telling us?
The put-to-call ratio is incredibly low. It's sitting at 0.21. That means for every 1 bearish bet, there are nearly 5 bullish bets being placed. It's extreme optimism.
Okay, 5-1 bullish. That's pretty wild.
And that euphoria sets up a potentially dangerous situation for anyone betting against it. Short interest is around 5.6% of the float. Not huge, but significant. But here's the kicker. The days to cover. It would take short sellers 17 days of average trading volume to buy back their shares and close their positions.
17 days. That's huge. So buying picks up.
Exactly. It's a powder keg. If a real buying frenzy starts, those shorts are trapped. The risk of a massive short squeeze is very, very real.
Okay, so the fundamentals are basically a ghost. Sentiment is off the charts euphoric. What about the technicals? Does the chart itself show this is real buying, or is it about to run out of steam?
Yeah. Well, the chart confirms the recent action. The trend is undeniably powerfully bullish, and the volume is high, suggesting it's real accumulation, not just the thin air rally. So that's the good news for bulls.
But there's a but, right?
Oh, definitely. The big warning sign is momentum. Indicators are deep into overbought territory. Really stretched. The stock is incredibly vulnerable to a sharp, sudden pullback, and volatility has exploded, which just confirms this is a high-risk, almost untethered move right now. It's like a runaway train, but the warning lights are flashing bright red.
Okay, let's try to synthesize this. We've got a generally positive market backdrop, but it's fragile. We have fundamentals that are, missing, sentiment that's euphoric, and technicals that are bullish but screaming overbought. Pulling all that together from our research, our verdict leans towards a cautiously bullish outlook. Emphasis on cautiously.
Right. That caution is absolutely key. The biggest immediate risks are that extreme overbought condition and the complete lack of fundamental support, plus the insane volatility. So for the bulls, the battleground levels are clear. They have to hold the $25 level. That's critical support now. And they need to push decisively past the recent high, around $30.27.
And if it fails, what's the breakdown point?
The key invalidation level for this whole bullish idea is a solid break below Friday's low. That's sitting around $19.80. If it breaks below there firmly, the story, the momentum, it's likely over for now.
So buying MFH here is basically buying the story, buying the dream. The chart says people are definitely excited, but you have to remember, charts that go up this fast, this vertically, they can come down just as fast, especially when there are no real earnings to cushion the fall. Something to keep in mind. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.